Andy Critchlow, 28th of April 2023. None of our former guests and speakers have been a world-class rider and cyclist. So you have come back in full loop, and we couldn't be more delighted than having you back on BRI Dialogues, because since last year when you shared your wisdom with us, a lot has changed, not least because of the latest detente between Saudi Arabia and Iran, with ramifications and ripple effects around the oil and gas, and brokered by no other than China. So what is the significance of this deal for the region, for the world, and energy markets, Andy?
I think it's significant, and we're already starting to see that. In fact, we've seen a number of major deals involving China and the Gulf states around energy over the last couple of months. I think it's really significant that Saudi Arabia has now joined the Shanghai Cooperation Organization. I think when you look at that, you've got to take it in the context of who else is part of that. You know, the other participants include Russia, major partner of Saudi Arabia now in the OPEC Plus oil producer alliance, and other major oil consumers, which both Russia and Saudi Arabia compete for access to those markets in, such as India. Other participants in the Shanghai Cooperation Organization include Kazakhstan, another member of OPEC Plus, Kyrgyzstan, Uzbekistan, Tajikistan. So, you know, this relationship very much is anchored on energy. You've had Saudi Aramco last month agree to invest in refineries in China. The importance of this is that it guarantees placement in the future of an additional, well, almost 700,000 barrels a day of crude, Saudi crude, for the foreseeable future into that market. And I guess, why is that important? Well, you look at the competition now between Russia and Saudi Arabia for access to that Chinese crude market, and importantly, Russia, according to the latest data in March, it shipped a record amount of crude into China, so 2.27 million barrels a day into the Chinese market. That's a jump of 12.9% year on year. It's really significant now, the volume of Russian crude going into that market. And indeed, Russia has actually surpassed Saudi Arabia now as the main supplier of crude into the market. And Russia could certainly supply more crude into China if it had a means to do so. Of course, the global tanker fleet is now fully utilized in terms of carrying Russian crude to new markets, crude that's been displaced out of Europe, predominantly into Asia. India, China are the main markets for that, but also you know, pipeline capacity outside the East Siberia pipeline, ESPO, is quite limited. Russia is trying to get more access there, but it will take time. So for Saudi Arabia, now is the opportunity to do these bilateral deals with China, invest in refineries, invest in transportation, invest in downstream petrochemicals, lock in future market capacity for its crude. We saw this 20 years ago, 20, 30 years ago with Saudi Arabia in the United States. Right. So before shale came along, before the Permian came along, Saudi Aramco, you know, the US was the only game in town. Before China joined WTO 2001, it was the US, and China invested in Gulf Coast refineries. It still has the Motiva refinery in the United States, which is very much the bedrock of its relationship there. But it certainly turned its gaze towards China, and it's applying in very many respects the same sort of foreign policy or energy policy strategy that it used to employ with the US when the US was a significant customer to China now.
And Andy, this is absolutely fascinating. It's clear that, you know, the Saudis have stolen a march on virtually all of their OPEC partners and competitors. But what's your take on the Chinese interest in brokering a détente between Tehran and Riyadh. I mean, yeah, I get the big picture in terms of stability, and it's better not to have your partners fighting each other. I get all that, but looking at it from your perspective of the energy market, Iran is going to be the loser no matter what happens here, particularly if we bring gas into the equation. That the Chinese have now green lighted Qatari gas, LNG, going to China, which again will be at the expense of the Iranians. Is it a lose-lose thing for Iran and win-win for these GCC market leaders?
It depends how much access Iran is prepared to give. So, although China can invest on a limited scale in the downstream in Saudi Arabia, it has no access to the upstream. And, in terms of energy security for China, and China plays the long game, and having that joint venture status and being able to have a stake in the upstream to allow its international oil companies to go and help develop fields, to help develop reserves, that is a long-term guarantee in terms of its energy security. And China, is on a different trajectory in terms of energy transition, whereas the US and Europe, they're trying to disengage from oil as quickly as possible. China sees it as a big driver for its economic growth for the foreseeable future. I think it's interesting because, is China thinking, well, actually, we can broker this deal, we can get normalization between the two great power forces in the Persian Gulf, Iran on one side, Saudi on the other. We get that normalization. We kind of know that the Saudis are never going to let us have access to their upstream. They went a different way. They decided to IPO Aramco and bring private investors there. That's kind of not really what we want. We'd rather have boots on the ground, being able to develop oil fields. And then you look at Iran. And Iran's in a difficult position because it's lost so much ground in its upstream. It's been starved of technology. It has gone from being, the second largest producer in OPEC, the second biggest voice in the room, in OPEC, incredibly influential, to being isolated, to having declining production, to having its access to international markets constrained by sanctions. But more importantly for Iran, to have its ability to develop its reserves. And Iran has vast reserves, well in excess of 150 billion barrels of crude that could still be tapped. Huge fields around Azerbaijan, huge areas of the Persian Gulf, South Pars that haven't been developed for gas. Its resource base is absolutely vast. In many respects, it is the last frontier now. Weirdly, because it was the first frontier when, over 100 years ago, when oil was first being developed. It was the first frontier in the Middle East. And perversely, it again now is the last frontier left, where actually, what Iran is starved of is investment capital. It can't get financing, it can't get investment capital. Sanctions prevent it getting export credit guarantees. Sanctions are sticky, and even if you had normalization with the US, it would take years and years and years for these things to come off. Does China care? I don't think they do. Is the Iranian regime pragmatic enough to say, well, we see China as an ally, we are aligned with this new, in this great power game which is developing in the world now, we're very much aligned on this side. And we could give access because Iran has been more pragmatic historically in terms of giving access to foreign investment to its resources. So you had Shell in the past, been very active on the ground in Iran, helping to develop its oil and some of its gas resources. Total, all the major international oil companies, the Western ones, prior to sanctions, were very keen, and Iran was very proactive in that, and it had a series of oil ministers who were very keen to promote that. And many people thought when Bijan Zanganeh was brought back as oil minister, of course he's gone now, that Zanganeh was being brought in to kind of facilitate that shift to bringing investment in again, and then sanctions blew all that up, and it was just never going to happen. Could they do this with China? Absolutely. Does China think, well, we have a better chance of getting access to these reserves if we partner with Iran? Absolutely, I think. And its geostrategic position globally, very much key to the Belt and Road story. which cuts through China's foreign policy, cuts through China's economic policy, building this bridge to the Africa and the rest of the world via the Middle East, via the Caspian, and we're going to see more of it.
Andy, always enlightening to listen to you, and I know that we want to drill down, but I want to go again a little bit to elevate the conversation to a few 40,000 feet with your help, and that is to take it back to the bigger dialogue about OPEC plus and the NOPEC that United States would love to break up the cartel. That is becoming ever harder, right? You know, because I don't know. I mean, you have followed for sure the discussions between Lula de Silva in China and Petrobras, sector, and how will that play with IEA? Is OPEC getting as a result more stronger? And with this talking from both sides of the mouth that we have to go to net zero, but the licenses for drilling under Biden have shot to the roof. So this idea of moving away from oil and gas versus the reality on the ground in the United States on one side, on the other side, OPEC is becoming ever more, or OPEC plus for that matter, in the growth story of India as the largest population on earth, and the coming off from coal, and China ever more important. How do you see that breakup chance, and how big of a threat that is for the GCC producers and Persian Gulf producers and Iran at large?
I think OPEC plus, well, I think OPEC has become more powerful, but it's become more powerful because of the inclusion of Russia and its expansion. And you know, on the one side, that has solidified and strengthened its position in terms of global market share. It now controls pretty much half of the world's oil supply. And then if you look at reserves, available reserves that you could tap into, spare capacity, there's only one show in town, it's OPEC plus. I mean, you know, Saudi Arabia has for many years battered away suggestions that you know, OPEC doesn't serve its interests anymore. It would be better being part of a broader economic alliance with the United States, with Western powers. But actually, you take away the G20, take away other international institutions. OPEC is the most important economic institution, intergovernmental institution in the world. It's far more significant in what it can achieve than the IMF, than many global central banks. It is incredibly influential because, and as we saw earlier this month, surprise OPEC cut of up to 1.6 million barrels a day of crude, voluntary, so done without a meeting, just very quick, very nimble, very reactive. Completely shocked the market. You had a spike in prices. It sets the tone because now OPEC is basically saying we see $80 as the price floor. We don't want prices to fall below that for Brent. That's very much linked to the fiscal break-evens in these OPEC countries. So it's incredibly nimble, incredibly powerful in terms of its economic consequence. Because remember, if you start getting oil prices ticking up to $90, $100 a barrel, then crude starts to become a driving force behind inflation, behind where the global economy moves. And all the central banks then have to react. They have to change their policy. So it's very much if you're in Washington, D.C., the cart is pulling the horse, right? But if you're in Riyadh, they are very much pulling the cart at the moment. And I think it's a problem for the West because the US has historically been able to exert influence.
Yeah.
You know, the US presidents successively have been able to call the King of Saudi Arabia and exert an element of pressure to change policy, whether that, and there are a number of historical examples of when that's been done, 2003, back to early 1990, 1995, you go through it. It's been a common sequence, and in many ways that is what undermined OPEC as an institution, because the US knew that it could always get on the hotline to Saudi Arabia, to its core Gulf state allies, and get them to change policy favorably. That's now gone because Russia's in the room, and these key OPEC states, these key Gulf Arab OPEC states, see their future closer aligned to Russia, closer aligned to China, closer aligned to India. Now, the interesting thing is, at what point does China and India say, well, we don't actually like oil prices at $80, $90, $100 a barrel. It doesn't help us. It drives inflation. We are dependent on you for our crude supply. Yeah. And, you know, India especially has pushed back more aggressively than China, especially with Saudi Arabia, especially with other OPEC countries, about higher oil prices in the past. So, you know, it's very much kind of how does this relationship look in 5 years' time, when actually the global oil market could be smaller if you believe the energy transition narrative that we're kind of heading towards peak oil, and the oil market then starts to look smaller, and everyone who's producing crude is trying to force it into these Asian markets that are still growing. And so there's this race going on between these OPEC producers themselves, you know, whether it's Russia, whether it's Saudi Arabia, whether it's the United Arab Emirates. And you know, let's not forget the competition between the Gulf states themselves. And that brings tension into this, you know. And so I see OPEC Plus as I don't see it going anywhere fast. The only thing that can change that is what happens on the battlefield in Ukraine this summer.
Andy, you've got my head spinning again, which actually is a good thing. So, I mean, I've got about 1.5 million questions, and Ali won't let me. But on this particular point of price volatility, is it true to assume then China, and to a lesser extent India, are protecting themselves from those price rises by virtue of discounted Russian oil? That actually they have access to oil that the West has cut itself off of for very good reasons, in my view. But nevertheless, the Russians have nowhere to go but to sell to China and India at vastly discounted, from what we gather, prices, which means that the inflation probably in oil prices of 85 and 90 plus is probably something that already discounted. Is that true reading of the situation globally?
It's absolutely the case, and it's not just China and India that are doing this. So, you know, they can purchase Russian Urals crude, you know, at a discount of, you know, $18, $19 a barrel at the moment. So, you know, of course you're going to do that, and you're going to, you know, they would buy more if they could. The reality is they can't, because there just isn't the capacity to bring it into the country. There isn't a tanker capacity globally. There isn't the pipeline capacity. Where sanctions have been effective actually is in targeting the financial transactions which actually underpin oil contracts. So it's things like the insurance, it's things like the underwriting of the ships, etc., which is very difficult to do. So Russia is having to rely on its domestic fleet, and it's having to rely on other quote unquote clandestine fleets that are prepared to take its oil and cut corners to avoid these sanctions. But the capacity there is limited, because again, everyone wants to load their crude onto a vessel and take it to market. So, you know, it's not limitless, the extent to which China and India can take advantage of this discount crude, but it is significant. And we've seen that with, you know, the record imports into China last month. I think, though, that it's not just China that's doing this. It's also Gulf states which are doing it. And of course, coming into the summer, this is going to be more of a factor, because the Gulf states, historically, countries like Saudi Arabia, they have to run a lot of fuel oil through their power generation facilities and water desalination facilities. They're major consumers of their own crude, in actual fact, especially in the summer when demand goes up. That reduces the amount of available feedstock they can export. So, you know, if you're Saudi Arabia and you can buy Russian fuel oil cheaper than your own fuel oil, you know, buy it and then export your own fuel oil at market prices, and you make a very healthy profit. And it's this, you know, a great example of mercantilism taking precedent over, you know, what could be seen in some quarters to be the politically right thing to do. So the oil market globally is being changed, you know, daily by this. and it's very difficult for the US to stop it, and the Western allies who are opposed to Russia in Ukraine to stop it. Now, their response to that criticism that actually sanctions and the price caps are actually they're not really limiting Russia's ability to fight the war. What they've actually done is they've kept the Russian economy on, well, not even life support. They've kind of put a bandage on Russia's economy, because for the US, for policymakers in the US, if they were to employ a blanket sanction on all trade globally of Russian oil, even if that's possible, and it's not necessarily the case that it would be, if they were to do that, then you get the oil shock scenario that we saw in the 1970s, the massive queues outside petrol stations. It becomes political. And, remember, we're soon going to head into election cycle in the US. So Biden doesn't want this. He'd much rather just keep, be seen to do something, be seen to do the price caps. Of course, the EU has been aggressive in we're not going to buy Russian oil, we're not going to buy Russian gas. But even then, it's still porous. So it kind of keeps the Russian economy on life support, and it allows Russia to continue to fight its war. And that's the criticism. When actually, if they'd wanted really to stop Russia in its tracks, you just completely seal off Russian exports of oil. But realistically, that would tank the global economy. So it's very complex.
Catch-22.
Whether this strategy will actually work. And when I put this to US policymakers, they do kind of scratch their heads saying, well, are you really serious, thinking that we should have tried to kind of suffocate all supplies of Russian oil? But actually, reality is, with the strategy that they've pursued, all they're doing is extending the pain, and in giving the war more time to run its course in Ukraine. And let's not even go into the risks associated with that. They're creating the environment for Saudi Arabia to do more deals with China, for China to do more deals with Saudi Arabia, for Beijing to chip away at all these key alliances in the Middle East that the US and other Western post-imperial powers like the UK, like France, other European powers have taken. It's taken generations to build, and it's being chipped away at by China, by India, as we speak.
Andy, you talked about Saudi's domestic needs. I have read that around $20 billion will be going into cloud and data centers. They have major ambitions to develop that technology front. All of these data centers are power hungry. Talking about technology, I have a twofold question for you. One is that, what is the future of trading in oil markets with the arrival of generative AI and ChatGPT and thematic algorithm momentum funds? And how worried we have to be about that area, that a headline comes and the market starts. In the old days, there was the wise Andy Critchlow that people go to and say, where is the market going? Today, if Andy is spinning on his bicycle in a circuit, the momentum funds will run with a headline, which that headline itself may be a false flag generated by another news outlet. Where are we going on that front? And sticking to that, isn't this new détente between Saudi and Iran a plus for Saudi's needs as well to buy cheap oil from Iran as well, or to invest across the Persian Gulf? So I leave those two simple questions to you.
Not easy ones. I think on the algorithmic trading and the use of AI in trading, it goes a long way, beyond, oil. At various times in my career, I've reported on central banks, for example, and the way central banks release their data, often they'll invite news organizations, into their monthly meetings when they do the data releases. And interestingly, the different news organizations, whether it's Reuters, Bloomberg, Dow Jones, they'll actually, the central banks will charge them to plug their systems into their IC system. And it's the length of the cable. And this is all regulated. This is all, officially how it's done. So when the central bank releases its print on this is what our policy decision is going to be in terms of money supply this month or interest rates, it goes out to financial markets within a nanosecond, and that nanosecond is determined by the length and thickness of the cable, or it used to be. And because all these financial news organizations were tied into their customers, which are large trading houses, which were especially in money markets, using algorithmic trading to activate trades and make or lose billions, trillions, even in some cases, probably. And so it's been going on for a long time. I mean, that's when I was part of that world, that's 15 years ago. And so I suspect it's actually got a lot worse. What we look at today, what I look at, is very much the physical markets, and the physical markets are very much done in algorithmic trading has a less important role to play in those physical markets. However, in the oil futures markets, which are tied to the financialization of the industry, then yes, AI is increasingly going to be a major part of how crude is traded going forward, I believe. And the major trading houses, the major oil companies that operate trading houses are all aggressively investing in that and looking at it. It's not just them; it's banks as well, and these sort of non-traditional participants, in the oil market. Do I think that there is a huge potential for a fat finger incident going forward? Well, I think they probably happen far more regularly than we would hear. But I think because the oil market really is anchored on the physical market, physical sale of cargoes of crude loaded at certain points in the world, then I think it offers probably more protection to the kind of systemic kind of meltdowns that you see in things like money markets or in stocks and shares. Because ultimately people still need, at some point, that crude has got to get loaded on the boat. The boat's got to sail to where it's going, and it's got to get unloaded because people need the product at the end of the day. So I think it's the exposure of oil markets to AI and to these different forms of technology is as a risk is very different to what you see in financial markets, in equities, in capital markets. That is not to say that AI and different forms of tech are not transforming it as we speak. And yes, I mean, your point about Saudi Arabia and other Gulf states aggressively investing in in that. Do I think it gives them any sort of competitive advantage in that world? I'm not so sure. I'm not so sure. I think it's more interesting in that area is the investment that you're now seeing in these Gulf state producers starting up their own international oil trading houses. Mm-hmm. So we've reported a number of initiatives over the last few months. So you have ADNOC aggressively setting up its own international oil trading unit, very much anchored on their rollout of these deliverable crude contracts for their key grades of crude, Zakum and Murban, at the same time that they're doing this. And these are significant streams of crude. Zakum and Murban, you're talking 2.6 million barrels a day of crude potentially. And the grade of those crudes, this is the biggest kind of grouping of crudes within the OPEC basket. So it's, pretty significant move by them. And, at the same time, they're opening up a huge storage site in Fujairah, which will store something in the range of 30 million barrels of crude, the largest in the Gulf.
Are they doing this in partnership with Vitols and Glencores of the world, or are they doing it on their own? Do they have the know-how? And then I know that Anush wants to jump in. So
yeah. I mean, ADNOC are doing that on their own in Fujairah. In fact, it's completely separate to the Fujairah International sort of free zone area and the Foy's area, where the likes of Glencore and the likes of Vitol, do have storage. But that's more focused on the product side. What ADNOC is doing is very much crude, and they've got their own mooring buoys offshore there. But it gives them access to market outside the Straits of Hormuz. They've got a massive pipeline, the Ruwais pipeline, bringing in crude. It's a very reliable way to market, and it's pointing, importantly, it's pointing east, and it plays into this narrative again.
Yeah, Andy, I'd love us to explore a bit more. Hopefully, we will, about what's the advantage for Emiratis, for example, setting up their own trading houses. But I want to take you outside of the warmth of the Persian Gulf for a minute and immerse you in the Mediterranean Sea, and talk a bit about natural gas, because we know that there's this forum of Cyprus, Lebanon, Israel, Palestine, Egypt on the one hand, exploring the offshore in particular, and Egypt seems to be making quite a lot of headway, as indeed is Israel. Then we've got Turkey and its interest, but also recently, as you'll know better than I, that they announced this offshore field in the Black Sea that they're going to start extracting from, and then sending it off to Europe. It seems to me that natural gas is now become the flavor of the month, as crude is becoming as this battle boy of pollution and climate change. Some argue that actually natural gas is not much better, but at least it seems to be something different. But also, as a different product, it has all sorts of other technological, environmental, economic, infrastructure dimensions to it. So that's one question. What do you think is going on in the Med and Turkey's kind of new discovery of this field in the Black Sea? But as you know, they're about to inaugurate their first nuclear power plant with the help of Rosatom as well. And I don't see much evidence of China being that focused on what's going on in the Eastern Mediterranean. Could you shed some light on these two issues?
Yeah, I mean, I think it's the development of East Med gas, Cyprus, Lebanon, Israel, Egypt, of course, Damietta, and kind of West Delta gas at the mouth of the Nile. These plans have been around a long time. The issue has been investment. Cyprus is a good example. Cyprus has at least for the last 10 years been trying to drum up interest to develop its natural gas resources offshore. Egypt has had more success, but interestingly, the majority of that gas is kind of sucked into the Egyptian economy, and its ability to actually generate significant amounts of export revenue have been limited, and it's also had problems historically attracting investment. And I think when you look at East Med gas, I always think of it more as like Southern Med, because I can't help thinking about Libya. And you look at when I first got into journalism and reporting, my first beat was Libya, and that was when Libya was developing their major gas pipeline into Italy via Melita and the Italian energy company Eni, and this was meant to be this is going to be feeding Southern Europe for generations. And of course, the narrative was it's secure, we can do a deal with the Gaddafi regime, we trust them, vast resources, and then what happens in 2010? And now no one's talking about building new gas pipelines in Libya. They're talking about keeping the old one open. Algeria, again, very interesting. In the prospect that they've just had some changes to their hydrocarbons law, the prospect that we're going to get more Algerian LNG in the future. And Algeria, interestingly, it was the first country in the world to develop LNG commercially. I think it was the first LNG plant that was built there in Iran, if I'm not mistaken, and in the 1960s. And traditionally that gas has flowed via LNG transporter into Europe a short way, and of course they have a pipeline as well, but they want to supply that. So there is an awful lot of gas around the Med. Up until now, people haven't really wanted to invest in it, and I think that even today this is still the issue, even with these record high prices that you've seen, although they have eased. So we've gone from gas TTF trading at what, 500 euros a million BTU to I think we're down to about 50 now.
37, 38.
Yeah, 37, 38. So yeah, and that's still double what it should be. It should be around 20. And it's interesting because gas has always, as a commodity, gas pricing has always been seen to be far less volatile than oil. So that, the industry has been structured on these long 20, 30-year offtake agreements that developers would sign with utilities historically to either build LNG facilities or to build cross-border pipelines. The cross-border pipelines actually in the Med have always been the more problematic ones because they become very political. So do I think that you're going to get a big rush of investment into these projects in the East Med? Yeah, I think that a lot of these, will actually happen. Will they be commercially viable, though, in 10 years' time? Now, that's another question, because coming to your point about gas as a fuel, 10 years ago, people were saying gas is going to save the planet. And then about 2 years ago, people started saying, well, actually, gas is pretty nasty stuff and we've got to stop using it. And, it's bad. And that narrative has picked up, and gas has very much become part of the fossil fuel basket of nastiness, which is blamed on climate change. So to what extent can all these European countries, which is the key market for this East Med gas, can they decarbonize if they continue to use gas? And the question is, and this comes out in IPCC reports, it comes out in lots of different UN reports now, they can't. And the EU starts to realize, and that's why they've started to wind back on their commitments to kind of phase out gas. But they don't want to be producing it. So, good example is Holland and them shutting down the Groningen field, which is absolutely vast and could supply gas for, all of Holland and pretty much all of the, the Benelux countries, and more after that. But they don't want it, and they don't want the earthquakes, and they don't want the risk, and they don't want the environmental consequences of it. Now, all that moral baggage, Erdogan doesn't care. Turkey doesn't care. It's got this gigantic economy which is struggling with just rampant inflation, struggling with actually massive growing pains. It has the aftermath of this tragic earthquake to rebuild from. All Turkey wants, all Erdogan wants, is gas. And of course, we've got elections coming up in Turkey, and I had a conversation with someone about this the other day that, well, actually it's 50-50, Erdogan might get enough. In my opinion, I just can't see a scenario Erdogan gets pushed out. But whoever, if he did, whatever government you have there in Turkey, is still going to need this, cheaper gas. So it can either come from its own resources it finds, or it can be part of Turkey's East Med strategy to extend its influence and to invest directly, or do bilateral agreements with stakeholders to get access to that. I'm not sure I can see them doing that with Cyprus, though. Yeah, it's going to be it's certainly something that will follow over the next 5 years. Now, why is China not involved in that? I think that China is very much focused on the Gulf. I think that is China's A-game strategy now on a number of levels. One, it challenges the US in its backyard at a time when the US is directly pushing back on China's foreign policy in the South China Sea, pushing back on China's foreign policy vis-a-vis Taiwan. So this is a way that China, in actually being a partner, an active partner with these Gulf states, it's a way that China is knocking on the US door and saying, we are here, you're not the only fish in these waters anymore, we're there, and we've got probably bigger teeth than you. And that's very much happening. I don't think that they don't want to have the same skin in the game in the East Med, because there's nothing there for them. Whereas, having these core relationships with Saudi Arabia, having these core relationships with Iran, which I am sure came as an absolute surprise to the US. I'm sure it came as an absolute surprise to a lot of EU policymakers. That serves their kind of longer term foreign policy goals. And of course, you know, you've seen China doing now, they did their first investment offtake agreement with Qatar for LNG last month, and we'll see more of that.
So all of this reminds me of Jerry Maguire and saying, "Show me the money." So now you tell me, because 4 years ago, before Russia became the persona non grata as it is today, I wrote a piece of paper, Anush is aware of that, making the case that the BRICS plus Iran should create a new currency, call it resolve, resilience, whatever. Lo and behold, 4 years later, Jim O'Neill has come out, the man who coined BRICS, and it gave my big, bold forehead a glow of joy that it was seconded by him that BRICS have to create their own currency. Now, you add Saudi Arabia's selling in yuan, and I put that link in our, episode for our audience of that article. Key question is, if the trade, global trade in yuan has increased from 1.4% in January to 2.5% in Feb, and if the OPEC Plus shift to selling in their own currencies, in real, ruble, rupee, rial, and yuan, or renminbi, to keep to R6, which was my article, how significant that is, in your view, as an oil and energy expert in shift? And will TTF, Amsterdams of the world, accommodate those transactions, or because they will be said, no, only in dollars or only in, euros?
Well, I think it's a very good point. Money talks ultimately, and if they're, if buyers and sellers can be matched in a different currency to dollars, it will happen. The point is, at the moment, that's not happening in enough of a volume to actually significantly chip away at the US dollar's position as the global trade currency of choice. And of course, everything rests on this. Pax Americana, the US position in the world will be fundamentally damaged by a shift of global trade to alternative currencies to the US dollar. And anyone who challenges that, well, just have a look at British history since the 1920s. It's one sorry story of decline, and that was all tied to the undermining gradually of the pound sterling as the major global trading currency, and that was sealed once we came off the gold standard. The same would apply to the US dollar if you had, in the scenario that all OPEC plus nations said, well, we're only going to trade oil in the future in a basket of our own currencies, or in quote unquote the petro one, it would change the world forever overnight. I don't think that they're at the point where they want to blow things up, partly because the United Arab Emirates has a sovereign wealth fund, if we're to believe what's written about it, that has assets in excess of $850 billion. Probably more. The majority of all of that is in, securities, equities, investments that are denominated in US dollars, or instruments linked to US dollars. So it would be, for the Gulf states and Saudi Arabia, especially because Saudi Arabia holds such a large chunk of its foreign currency reserves in US dollars, which are actually vital for all these Gulf states because they peg their currencies to the US dollar. So unless they have these huge US currency holdings offshore, then their own currencies and their own ability to maintain those pegs becomes very unstable. And so you can kind of, the blue sky thinking, the bankers probably pitching it to them saying, oh, you'd be better off ditching the dollar and having your own flexibility, and, we can come and advise you, and, you can pay us billions for it. What they don't realize is that it's not just the actual, not just the UAE that loses, it's not just Saudi Arabia, it's all these really wealthy families that actually sit underneath the rulers of these countries, that all their assets are in dollars. So it's in no one's interest in the political hierarchy in the Gulf states to actually see this happen. People might talk about it, and they might kind of throw it out there as a subtle threat, but it's a very difficult thing to happen. I think that, China would love to see this happen, but they just don't have enough of a sweetener to offer to the Gulf states yet to do that. And of course, if you're from the Gulf perspective, continuing to peg your currencies to the US dollar, continuing to participate actively in this global world where the dollar is the trading currency of choice for crude, for everything that you sell, then you're not closing the door on the US. In fact, you're actually giving the US a pretty good reason to keep that Fifth Fleet based in Bahrain, to keep those very expensive aircraft carriers prowling up and down the Gulf, because I'm not convinced, irrespective of all the economic arguments here, irrespective of all the crude heading east instead of west, I'm not convinced that these Gulf states are at a point where they would like, the Chinese Navy filling that void that will be left if the US pulled out. And of course, this is all ultimately what underpins this is because that is the big 40,000 foot view here. That's the big thing that changes the world forever if the US dollar ceases to be the global primary trading currency, right, for oil. So that's what's at stake, and we're a long way from having this petro yuan, I think, and we're a long way from having crude traded in a basket, although Russia is now selling its crude to anyone who'll pay anything for it, basically. So
sorry, jumping in, just making it to add to what you're saying, but the global trade within on other commodities, not just oil and gas, on cocoa, on copper, on plastics, whatever that may be moving between China and the rest of the world, can start moving to that bilateral currencies. Is it or not? Yeah.
No, I just don't see it, because the US as a market is still the world's largest importer, net importer of all commodities, aggregated. And that's foodstuffs. I mean, it's also a major exporter and producer itself. It is the world's largest, oil producer, by quite a margin now. But just the scale and the size of the US economy, it pulls in so much of everything the world produces. So I think that this story, it got a lot of oxygen a month and a half ago, and we were starting to see. And it's come around before, back in 2005, 2006, when you had very high inflation in the Gulf at the time, just prior to the global financial crisis, and that run up when you had oil at $147 a barrel. A lot of policymakers in the Gulf, I remember talking to at the time, they were seriously talking about, well, we need to think about having our own flexibility because we're tied to the Fed. And so we have this high inflation, we're tied to the dollar, we're importing massive amounts of inflation into our countries that's causing us lots of problems, and we can't really do anything about it because we've got no monetary flexibility. And so there was this dialogue about, well, could we shift to trading our crude in a basket of currencies, and then that would allow us to have that monetary flexibility and cut away from the dollar. It all comes back to how all these invisible ways, actually, the Gulf states, their actual economic wealth is actually tied to the US that we don't necessarily see. And that is quite difficult to calculate, but it all comes back to sovereign wealth funds, ultimately, because, it would be an act of economic, financial suicide for them to suddenly say, right, we're moving our oil trades to, I don't know, the petro yuan, because it would tank the dollar. So overnight, all their foreign reserves, all their foreign assets would be, however much the dollar fell, and it would plummet. It would be a car crash for them. So, and this is very much my opinion. I struggle to see it happening, and it's a story I've repeatedly seen over the last 20 years of reporting in the region, and it comes back. I think the politics around it obviously has changed because and the politics has changed because Russia navigates inflation very well with its flexible currency. And it's been able to use the ruble very effectively to insulate the Russian economy historically. from inflationary pressure. However, that is under normal economic conditions. Russia's not in normal economic conditions now, and I don't believe that Russia's influence in the Gulf states is deep enough yet for them to be able to be that persuasive. Because of course it would serve Russian foreign policy goals if they could talk Middle East countries into weakening their umbilical link to the US dollar.
Yeah. Somehow I'm not convinced that ruble will be the currency of choice, and the current conditions. But Ali and I have this discussion often with our guests, and I'm not convinced that actually China itself, when it comes down to it, can afford to de-dollarize, given how much of its own trillions are actually dollar indexed. That it will be a huge damage to its own economy and sovereign wealth funds were the dollar to crash in the way that is speculated. One thing. And the other thing is that the dollar has become like tap water. Yuan isn't. And for countries and traders, what you want is to be able to turn the tap on and off. And you can do that with the dollar. With restricted currencies, remember Yuan, you can't do it. So the attraction as a convertible alternative in the ways that remember, in the early 2000s, we were having the same arguments about the euro. The fact is that if it's not running out of the tap, it is not going to replace the US dollar. Do you agree with that?
Absolutely. And, come back to your point about the early 2000s, when we talked, we would, before we started the podcast, we were discussing, some anecdotal things that we've seen in Dubai real estate at the moment. And, it's a great barometer for what's happening in the rest of the world, because early 2000s, developers, they were saying, well, we don't want dollars anymore because the dollar was so weak and it was getting weaker and weaker all the time. They said, pay us in euros, because the euro was really strong at that time. And so, you had these stories circulating that, people would be going over to the UAE and paying for large apartments in with black suitcases full of euros. And that was, and this is where, people then started saying, seriously, well, could, we start trading crude and other commodities in euros? Could we start shipping LNG in euros or a basket of other currencies? It came and it went. The dollar is still incredibly resilient because just of the overarching scale of the US economy and the amount that it sucks in, the amount it consumes, the amount other countries are tied to it through different forms of invisible investment, and in the Gulf again, sovereign wealth funds. I don't see that anything is going to challenge that in the near term. And again, as your point, as you made, it doesn't serve, China's national interest at this point. Is that going to change in the future? Because all great, if you look at the big picture in terms of world history, all great political change and rising and falls of empires and major great powers, that it comes with changes to currencies. Constantinople, the Byzantines, that empire collapsed, primarily, politically, yes, the regime had become sclerotic. They faced an indomitable enemy that had more power, more wealth. But ultimately, if you look at Byzantine coins at the time Constantinople fell, the quantity of silver in the coin versus slag metal was these coins were tiny. It was bankrupt, and it had successively bankrupted itself. The decline of Rome before that, again, it was the same narrative: record inflation. The volume of precious metal in coinage was declined to the point where the coin wasn't worth anything. It cost more to mint it. And you go on from there, the same thing, the decline of the British Empire and British global hegemony, tied very much to the declining role of the pound as an international trading currency, Britain coming off the gold standard. Will we see that again in the future? I mean, I'm a great believer that you just need to look into the past to see what's going to happen in the future. Do I think it's immediate though? maybe not.
Well, one thing that is not in shortage today is the quality of the, how do you say, gold, in your words of wisdom. We should have a session on that, because I think quantitative easing and just printing dollars has been, a blessing for US. So the fact is US economy at large liquid? Yes, it is. But is it that on the back of just printing and monetary easing and then tying it? So I don't
look at the fires that it's lit around the world.
Come again? Sorry.
Look at the fire that it's lit around the world.
Exactly.
And these are I firmly believe that what we're seeing now is still a consequence of what happened in 2007. I remember colleagues of mine at the Wall Street Journal at the time saying, we will actually be counting the cost of what is going on here. We will be counting the cost of TARP, of quantitative easing, of this policy to just print money as a way to get ourselves out of trouble here. The real consequences will be in 10, 15 years time. Here we are.
Which is on steroids. But now I want to take you back to something which is somehow having a slow death, sadly so. And that is this dialogue about net zero. Drilling licenses shooting to the roof. Nord Stream 2, God knows what happened there. We will all find out by when the dollar is what's happening with Nord Stream and all of that. But now you tell me, how much of leverage and message would US championing decarbonization have for shipping LNG across the Atlantic and drilling and increasing its own oil and gas investment? RBC, Royal Bank of Canada, was the largest investor in oil and gas. I'm sure you follow that, Andy.
Mm-hmm.
How would this message resonate with the global South? That, hey, you have to come off oil and gas. Is really, this is, not hypocritical in more ways than one?
Well, it doesn't resonate with the global South. I mean, if you look at CBAM, the cross-border adjustment mechanism which Europe is bringing in, which effectively will force importers of carbon into the Eurozone to pay a fee. The big losers there are the global South. It's countries like South Africa, India, so there is this twin track economically being created in front of us around this. IRA, the Inflation Reduction Act in the United States, I think it comes to almost $200 billion worth of effectively direct subsidies for anyone who wants to invest in energy transition industries in the United States. That will radically, change that economy. But of course, there are protections and there are rules and regulations around where that protection, where that technology can come from. It will definitely incentivize US business to invest there. But does that mean that you're going to see a flood of Chinese solar panel producers coming into the United States to take advantage of that? I can't see it. In fact, I think that the Biden administration was quite shocked when it came into power and it learned how China had kind of gained a technological advantage in some of these important industries around energy transition. But the wealthy countries of the North, the US, European Union states, they can afford still to introduce subsidies, introduce price controls, introduce different measures to put a price on carbon and put a price on carbon being imported into their markets. And that's how they're going to tamp down on climate change going forward. And it does disadvantage the global South to a certain extent, but it all depends on whether these countries, will buy into it. I'm still not convinced, even with the various accords around, the COP meetings, various pledges to limit global warming to between 2 and 1.5 degrees. That in actual fact they will do this, because in so many of these, in China and India, in large parts of Africa, using coal, using fossil fuels is either the main way to power heating or transportation is much more cost effective. So where does that leave energy transition? I think it leaves it in a very tough place globally, because on a net basis, the largest emitters are very much in the global south and in Asia. However, on a per capita basis, they're very much in the northern hemisphere still. So it's very much North America. It's very much countries in Europe that and very much the Middle East, the Gulf states, on a per capita basis. They still have a lot of work to do. It's interesting that COP28 will be in Dubai this year at the end of the year, and that Sultan Al Jaber, CEO of ADNOC, is going to be heading that. Is it a good thing? Are we going to see, demonstrations and, activist groups openly allowed to express their views on this subject, which I think personally has been very effective in raising public awareness, activism, like you've seen from Greta Thunberg and groups like Extinction Rebellion. It's important to give people a voice, and that is what's put this on more than anything, actually, probably has put it on the global agenda, because people don't like their streets being blocked by protesters. They don't like being stuck in a traffic jam because someone stuck themselves to a road. This is the perversity of it. Whereas if someone 3 streets away has their house flooded, they don't really care. And so there's an important role in that, and I think that has always been kind of built into COP. And so it'd be interesting to see whether COP28 becomes more corporatized. Of course, the UAE, a major oil producer, even though it has made a lot of commitments to say by 2050 it will be fully decarbonized. Of course, the rhetoric in the oil industry now is it's not the oil that's to blame. It's not oil that's the problem, it's the emissions. And we need to focus on how do we get rid of the emissions so we can burn more oil. Whether that's going to work, my understanding of the science doesn't go that far.
Well, talking about roadblocks, we have come in full circle, and that's why you're always on a bicycle and smart enough to avoid the traffics. But a year later, has your advice for our cinephobe and cinephile audiences changed? If you were to leave them with one piece of advice, or you're sticking to your old recommendations, or in light of this global big power play, what is your, and in the world of energy that we are today, enough oil, peak oil, no oil, what's happening, and what is your piece of advice for the cinephobes and cinephiles?
The global population by 2050 is going to be 10 billion people plus. And, globally, we need more dialogue. And the breakdown of national institutions that have more or less prevented the escalation of regional conflicts into world conflicts. Institutions like the United Nations and its influence, the importance of an international rules-based system that is respected and stuck by. This is what concerns me, and that has to be protected and defended, and the argument for that needs to be made, because we are living now in a more multipolar world, and a world increasingly that is divided between governments that are more autocratic, that increasingly are seen to be stronger because of their autocratic nature of their governance, that are seen to be more economically successful because they may be large resource holders, versus democracies which are still struggling to deal with the aftermath of the financial crisis back in 2007, 2008, 2009. These democracies are increasingly being challenged by the rise of these great autocracies, which are in many respects forming their own intergovernmental pacts and alliances and organizations. OPEC Plus perhaps is a good example of that. A critical thing that we all have to look at is going to be the outcome of what happens in Ukraine this summer. Will we see a Ukrainian counteroffensive that gains traction? Will they be able to push Russia away from its territorial gains? Will the EU, will the US continue to support Ukraine with military assistance? Of course, some of that has to be voted for in various legislative bodies. Will you see Russia deepening its relationship with China? Will you see China directly providing military assistance to Russia? Will you see Saudi Arabia continuing to, I wouldn't say act supportively to Russia, but be very much on the fence, and it's certainly not the closest of allies, it seems, that sometimes with its traditional partners like the US in this argument. So much at stake. And then underneath all of this, you have energy transition. And, for my own personal interest, something that I've spent the most of my adult life researching, looking into, writing about is the Middle East. And oil transformed the Middle East, from the 1960s onwards, and large parts of the Middle East and the Gulf, which has always been my particular sphere of influence. What is the Gulf going to look like beyond 2050, which is definitely, I hope, in my lifetime, it will be a radically different place. And are the political structures, the social structures, the economic structures in place to manage that transition in an orderly way? And I think there's an awful lot more work that we have to do as thinkers, academics, journalists, to understand that and come out with some conclusions.
Yeah, and Andy, that's absolutely outstanding. As you're speaking, I was in my mind contrasting Yemen of today with Sudan of today. How you can see so very quickly institutions and order collapse without the world being able to do a single thing about it. And on the other hand, how very quickly this order can be contained by the nod and a wink of external stakeholders. So in a sense, we are all linked in one form or another through the crises that emerge, as well as the stabilities that we hanker and crave for. And what you say resonates with Elia and I very much. You've shown us again and again through our discussion that this talking about energy is actually talking about geopolitics. It's talking about international relations. It's talking about trying to understand human exchanges beyond borders. And very few energy consultants have that capacity to be able to link the discussion of energy to much broader global issues and transitions. And that's why we love having you with us. Some people used to say that if you want to understand international relations, don't go to foreign ministries, go to BP, go to Shell, and talk to their analysts, geopolitics analysts, and so on. And so you have a window on all of these, Andy. And so we are so grateful to have you with us, but also for me, again, to just continuously learn from you, which my age comes at such a wonderful thing. And so I'm really grateful that we've had you. Ali and I had given you a bike ride for your money, but given what you've ended up on, I think we're going to be back here again next year to talk about post-war Ukraine, to talk about China, to talk about energy transition, to talk about the next COP in the UAE, hopefully to talk about Turkey in transition in a more positive way from my perspective as well. So don't see this as a sign-off. See it as a revisit to come. So we are really grateful to you, Andy, for giving us your time and also your pearls of wisdom.
Thank you, Andy, for joining us. I hope by next year we have a technology, instead of carbon capture systems, we have ego capture systems, and the world will be in a better place.
Yes, absolutely. Well, thank you so much, both of you. I've really enjoyed it, and we'll be in touch. Take care.